Well, folks, Jerome Powell sent a very clear message to markets today. He does not care about the banking crisis. He does not care about the liquidity problems. He does not care about people losing their jobs. His main focus is bringing down inflation, and he will raise interest rates for as long as it is possibly needed to achieve that goal. The idea of a Fed pivot seems to be completely thrown out of the window after the Nasdaq and S&P 500 were down more than 1.5% given the FOMC remarks at 2 p.m. Eastern Time. There was a lot of hype going into this meeting, which was obviously the first one after the collapse of SVB and some of the biggest regional banks in the country. And I don't know about you, but the way that markets reacted to what the Fed said and the way Jerome Powell took on some of the questions from the Q&A section really rung some alarm bells in my mind, which is exactly what I want to discuss in this video. But as usual, guys, before we get into it, make sure to drop me a thumbs up and hit the subscribe button if you haven't already. Yes, you heard that right. I don't think the way that markets reacted today was exactly what many investors should have expected even after what the Fed said. As you can see, according to this Bloomberg chart released after hours, Yellen, who is the Treasury Secretary, is actually the one who resulted in the market being down more than 1.5%. After the Fed decision was released, markets actually rallied by more than 20 to 80 basis points. And when Fed Chair Powell opened his mouth for the Q&A 30 minutes later, markets actually tanked initially, but then rallied for the next 30 minutes, reaching a new all-time high for the day. But as soon as Treasury Secretary Yellen started talking about the banking crisis and what's going on with depositors, markets decided they wanted to tumble to the downside, closing down more than 1.65%. And this, my friends, is what is missing from the analysis from many people around today's stock market action. The reason markets tanked is not because of what Powell said or the 25 basis point hike that Jerome Powell signaled. It was actually because Yellen indicated the idea that they're not going to consider creating a blanket insurance policy on bank deposits within the US. As a matter of fact, what Yellen said was actually quite shocking. She said that the U.S. is not going to bail out any more banks by issuing more insurance for depositors. Instead, Yellen said that her main goal is to scrutinize the executives of some of these biggest non-banking firms that hold customer assets and how they invested themselves on their balance sheets. She says actually models might need to be revised over the next few years because it turns out that bank runs might be more inevitable in this new tech-driven era. The problem with this theory is that this could certainly hinder economic prosperity, entrepreneurship, and general development in the finance and banking sectors, which could end up hurting startups, venture capitalists, and obviously growth for most stocks. Because I'm sure, as we all know by now, the big tech sector, which is the biggest component of the S&P 500, was all backed by venture capitalism and banks like Silicon Valley Bank. This is the entire reason why growth and profitability is so high for these companies and how their executives were able to execute at such a high level. They had the access to the right markets, the right investors, and the right people, which is partially driven by the strength of the US economic system coming out of the great financial crisis. But it seems like just like real estate was a problem in 2008 and the tech bubble was a problem in 2001, the problem of the 2020s is the tech bubble 2.0, which is driven by Silicon Valley, high-tech, and software companies, which obviously were one of the leading depositors in Silicon Valley Bank. But obviously, as investors, that is something we can't speculate too much on because that is more on the fiscal policy side of things. Instead, let's try to understand what happened today with monetary policy and what the Fed did with its interest rate hikes and how it will affect markets in 2023. As you can see, the biggest headline is the idea that the Fed did not consider pausing its rate hikes for the rest of the year. As you can see, the Bloomberg Market Index is actually showing us that market participants are expecting the Fed to cut rates after every single meeting after May, meaning the terminal Fed funds rate could fall down to almost 4.2% from its current level of around 4.75 to 5.0%. But the Fed completely disagrees with this assessment, and here's why. As you can see in the summary of economic projections, which is something the Fed does not release every FOMC meeting, the terminal Fed funds rate for most participants on the board is expected to be around 5.1% for the year 2023. Next year, they expect it to come down to around 4.2% on average, and then in 2025 down to 3.1%. And because right now the rate is sitting between 4.75 to 5%, this means that by the end of this year, participants are expecting 0 cuts. Now, whether this is the right decision or not, I'll let you guys decide that for yourself. I personally think that the Fed is trying to stick to their political game of making sure they let markets know that they really care about inflation and they're not going to get it wrong this time. The Fed would realistically, in a situation where such banks have collapsed, would ease off the gas pedal, especially knowing that deceleration in inflation is already happening. But clearly they're driven more by their agenda at this point, especially with the election coming up in 2024. So as you can see from the December to the March dot plot on their summary of economic projections, their rate hike expectations have not changed significantly even after inflation reports came in a little bit cooler for February. Market participants are still expecting that interest rates will stay relatively stable for 2024 and 2025, with 2023 still sitting around that 5 to 6% range. And to be honest, at this point, I think this might be an okay estimation. I think the Fed should actually continue its rate hike cycle despite what's happened in the banking sector, because at this point we've come so far that it's worth just pulling the rug and seeing what happens instead of letting the pain aside for such a long time. Because we obviously don't know how sticky inflation is going to be apart from food and energy. Core PCE is still elevated around 4.5%. So at this point, raising interest rates to really flush out the system is a completely fine policy. And as you can see, that is putting us on track for one of the worst and most aggressive rate hike cycles in literal stock market history. If you've survived this rate hike cycle, chances are you're going to survive everything else that happens for the rest of the century. Because clearly, a pandemic-driven inflation event like we've seen right now is something that is very rare. And guess what? Even if the Fed continues to raise rates, it does not necessarily mean markets have to go down. Over the long term, as the Fed raises rates, markets actually go up. It's only when markets see an instant change in what the Fed is doing is when the markets react to the downside, because they have to price in the new monetary policy shift. And as of right now, the Fed has clearly outlined that they really just care about unemployment going up a little bit, which would signal that the stickier portions of inflation would start coming down, whether it be rents or used car prices, because obviously people would have less discretionary money to spend time on. That would obviously mean that most people in the non-tech spaces would be at risk of losing their jobs, and we certainly have yet to see this unemployment number tick up, which could be a sign that volatility is still going to last for the rest of the year. Now, I don't necessarily think that means that the market has not bottomed yet, because right now the market is running 6 months ahead of what the Fed is actually doing, clearly based on the massive rally we've seen since October. But as usual, let me know your thoughts down in the comment section below, and I'll catch you guys in the next one. Take care.